Hello, everyone. Today is Wednesday, January 22nd, 2025, and I'm Brian Tokuuke, Portfolio Manager here at the Rice Partnership, and I have with me today Orest Saikevych, Chief Investment Officer of the Rice Partnership, who will be giving us his 2025 market outlook. Hello, Orest.
Hello, Brian. Hello again, everyone. Happy New Year.
Thanks for joining us. And before getting into your outlook, how about if you could please give us brief recap of what kind of drove financial market performance in 2024.
Sure. Okay. Overall, U.S. stocks did well. Okay. Led by the S&P and the NASDAQ. Another 20+% gain. The Dow Jones Industrials were a little bit of a laggard, and the smaller caps a distinct laggard there, as were international equities. Fixed income was kind of a dichotomy. The short end did much better than the longer end. The longer dated 10 years and up maturities, I had another tough time. The 10-year Treasury went up about 100 bips or a full percentage point from about 3.6 to close to 4.6. So at any rate, a little bit of mixed performance there. Overall, I think we can attribute to the performance on the equity side, at least, to a good economy. That's usually the driver of returns, and it was this time. A good economy, better than expected, which led to good consumer spending overall. And keep in mind, the consumer is 70% of GDP in this country. So that led to good earnings, and good earnings led to higher stock prices. And so in a nutshell, that's what happened last year.
Oh, thank you for that. So based on 2024 and where we are today, what is your outlook for 2025?
Okay, so let me start out a little bit with the overall environment we're in, and before I get to the forecast for this year. I recall late in the year, 2024 was an election year, and everyone said there's election uncertainty. Well, that uncertainty is gone. I think the only real surprise with the election was the fact that the GOP swept all three branches: the presidency, the House of Representatives, and the Senate. Okay, which gives the GOP more of an opportunity to try to implement their agenda. Okay, and their agenda, I think, can be best described by TDIT: taxes, deregulation, immigration, and tariffs. Okay, some of these are positive for stocks: the taxes and deregulation. Immigration and tariffs, not necessarily. And certainly for bonds overall, longer bonds, it's probably more bearish. But I'll get into that in a little bit. So those are pretty much the four main drivers of the administration's policy this year. And a lot of it depends on the sequencing of events. Okay, in other words, which is going to come first? Are we going to have taxes and deregulation come first, which is really good for stocks, or immigration and tariffs? And so the timing will be very, very important. The situation's very fluid. It evolves daily. Looks like right now, at least as of today, immigration is going to be front and center. President Trump has already said he wanted secure borders. He's using tariffs against Canada and Mexico to achieve that purpose. So it looks like immigration is going to be out there first. Deregulation also will come early because it does not require mostly congressional action. So that's more agency or can be also affected by executive order. Okay. Tariffs, it's our feeling that even though Mr. Trump has come out and suggested draconian tariffs for China and also for our other trading partners, there's a reason to believe that those are going to be selective to a degree and that they're going to be staged. Right now, the president has gone after, as I mentioned, Canada and Mexico. I think once he's done there, he's probably going to concentrate on the Eurozone, where he has a big beef with. And then he's going to get down to the 800-pound gorilla, which is China. Okay. So probably in that order. And then finally, taxes, which is, obviously a positive for stocks if the taxes go down. We think that's going to be last because Congress has to pass a tax bill and it has to go through the House. Right now, the Republicans have a razor-thin majority there. So that may take pretty much most of the year. Okay. Now, as far as getting back to bonds, I think, with bonds for this year, it's, the bond market right now, it's a tale of two cities almost. If looking at the shorter end, which is influenced heavily by the Fed funds rate, which the Federal Open Market Committee sets, we see the possibility of one or two more rate cuts. It looks like the Fed has gone back and done away with their recalibration due to the fact that the labor market has remained decent. Okay. And that's led them to cut back on the projected cuts to 1 to 2 this year. Longer rates, on the other hand, if you look at the 10-year Treasury and 20-year and 30-year, that is kind of goes to a different drummer because longer rates are influenced more by concerns about longer-term budget deficits. There's quite a bit of angst in the bond market, whether or not Mr. Trump's policies, when they're fully enacted or at least partially enacted, what they will do to the budget deficit, which is already very, very high, as we know. So we think that longer term yields may continue under pressure to go up, meaning that the bond prices could go down. So we've maintained a barbell approach for 3 years, and it's served our clients well, I think, because the short-term approach is a short-term fixed income, which is really a money market, has done very well. Yields were close to zero in early 2022 because the Fed funds rate was that low, and they went higher with the Fed funds rate, topped out around 5%. They're down now to around 4.25%, 4.5%. They've fulfilled a diversification function very well. And, so don't consider money markets to be cash. They were once cash when yields were close to zero, but right now at more than 4%, that's pretty good. So we like that, and we like them as a hedge overall, a part of the portfolio. The longer end is for non-taxable accounts. We have a global bond fund, which doesn't have to necessarily be invested in longer dated U.S. treasuries. They can go anywhere, other countries. They can buy corporate bonds too. So we like that. And for taxable accounts for people in high tax brackets, we recommend individual municipal bonds because of their after-tax yields are very good to people in high tax brackets. And most of the credits are very good, okay, because states and municipalities have to get their budgets balanced statutorily. So we like that approach. On the equity side, as a result of the election, we made some tweaks in the international equity portion. We've trimmed that back overall, and we've also restructured it within that asset category. We took out Mexico because Mexico is obviously got a big bullseye on it with the new administration. We also took out Indonesia because Indonesia has had a weak currency, and unfortunately, foreign stock markets might do well, but then when you translate the earnings to U.S. dollar terms, if their currency is weak, it dilutes the overall returns. So we sold Indonesia. We also converted Japan to a currency hedged ETF, which takes out the effects of currency. We've got out of the Netherlands ETF because, once again, the Eurozone we feel is going to be in the president's crosshairs as far as tariffs. And we got into Switzerland, which is not part of the EU and has its own currency, the Swiss franc, which has been historically strong. And it's a good haven. Switzerland isn't a big trading partner of the US. So, the countries we're in now, Switzerland, Japan, we're still in Australia, which has a fairly good currency, and India, which we feel is going to be a beneficiary of a lot of the tariff repercussions. We think a lot of companies are going to continue to try to move manufacturing facilities out of China into India. So we think India is going to be benefiting from that. So we've restructured international. Some of the money we've added to a new asset category called SMID, or small and mid cap. We're emphasizing the mid cap portion. We're in a mid cap ETF because mid caps we like better than small caps. Overall, the mid cap arena, which is 5 billion to 20 billion of market cap, we feel is stronger. Most of the companies in that market capitalization are profitable. Also, their access to capital is much like the large caps, so they're not as interest rate sensitive as the smaller caps are. And so we like that new area of the portfolio. So as far as U.S. equities are concerned, we're, make a tweak or two here or there, but we feel that we're well diversified and well positioned for the market as we see going forward into this year. We think U.S. equities are going to do well, although I would caution against having another 20+% year like we did last year and the year before. But we do think that equities should do well in this environment. Since the new president himself, has said on more than one occasion that he looks at the stock market as being a report card on how he's doing on the economy. So with that in mind, that's our outlook for 2025.
Awesome. Thank you very much for that. Thanks, Orest, for your 2025 market outlook. And to everyone viewing, thank you for tuning in.
Thank you very much. Take care, everyone. Talk to you next month.